It's muted.
Yeah. Good evening, ladies and gentlemen. Welcome to our session where we're covering divergences. We've been talking about trends before, we're talking about analysis, looking at the price action, talking about your friend in the market is a trend up until it ends, but then you will need to check out when there is the end of a trend. And one of the occurrences or setups you need to look out in the markets or check out for is the divergences. So me and my colleague, Sam, will be telling you more about the divergences and what you can look out for and the indicators you want to check out. Sam, you're here with me, right?
Yeah, good evening, everyone. So today, as Mathew said, we'll be looking at divergences. So this is for those who like trading reversals and also those who trade trends. Because when you are trading a trend, then it's good to know when it's the riskiest time to enter. And if you start seeing things like divergences, you'll probably pause when you're trying to follow the trend. So this is what we're going to cover this evening, and we hope you pick something from this.
Exactly. So we've both mentioned about change of a trend, but you can as well use the divergences for a continuation of a trend. Yeah.
Yes.
But before we look at the setups and the examples, what is a divergence in technical charts? It's basically where you're looking at the indicators which you are using and the price action showing different things. Yeah, like you have an uptrend on the price action, and when you look at the indicators, then you're seeing it's not being confirmed, right? And the most common indicators that you're going to use for divergence, to show divergence with the price action, is the relative strength index, the stochastic, and the MACD. Some will also would want to use, or some will use CCI. So long as you have an oscillator which is moving between 0 and 100 or between some levels, and then you're also looking at the price action, you're likely to see inconsistencies in the movement of a trend. And that's when it's an opportunity you can exploit to get some entries in the market.
Exactly, because these indicators are meant to trail the price on the chart, and once they start doing or showing a different direction or movement from what is happening in the charts, then that's when you realize there's a divergence between what is the price and the indicators itself.
Yeah, so this is a plan where you're analyzing the market to find out, do we have some form of disagreement between maybe the momentum, because the indicator might be showing strength of the current trend, might be showing the momentum. By the way, you can as well use the momentum indicator or even volumes. Yeah. So if you realize that the current trend is not in line with the volumes that are being implied by the technical indicator which you're using, then it gives you some kind of a warning, yeah, or some kind of a signal that something might be changing. Okay.
Exactly. Yeah.
So, and that's what the divergence will show in a chart. Gives an indication of a trend weakness and a likely reversal. Yeah. And then you can join in the start, or you can be prepared to check out for a confirmation of a new trend, starting of a new trend. Yeah.
Just a question there, Mathew. Do you think we should be using divergences with other methods of seeking entries or confirmation in the market, or is it possible to just trade divergences independently?
Okay, I would definitely say, Sam, that it's always going to look for a confluence or confirmation of another indicator. If you can combine several indicators and they're showing you the same direction in the market, then the better. So I would support if you can get another indicator or something else you can use in the markets to confirm that the divergence or convergence which you're seeing in the market, then it will always give you a higher level of confidence of the likely direction that you see in the market. So I would support add something else that can give you an edge or even higher level of confidence or even more confirmation. A confluence is better always. If you can see a key technical level, technical area, then that's okay.
Yeah, okay.
Yeah. So as well, you can check out for trend continuation using the divergences. We will check out. So there is another approach where you have regular divergences and you have the hidden divergences. Yeah, so mostly the regular divergences will give a reversal of a trend, but then the hidden divergence is where you find a trend continuation. Yeah. Yep. So these are just examples of bearish and bullish divergence, where you have, in the first case, you have prices making higher highs and higher lows. So when you check out there, the price actually is just showing an uptrend, but when you look at the lows on of the oscillator, it's showing something different. Okay, so this one is likely to give a bearish move. Okay.
Yeah, so it's more of the potential of a bearish move rather than the actual bearish move, because from what I've understood you saying is we need to have more confirmation that we are going to indeed have a reversal in the market. So yeah, so does it mean that we should still be holding up to the trend and we wait, or how do you think we should go about exactly?
You want to see a confirmation to any signal which you get. So when you get a signal that there is a weakness, okay, or there's an implied weakness that you can exploit in the market, then look for some confirmation. A confirmation always better. That's what you were asking previously. Yeah. Whether you need to use something else or you just independently use all these divergences alone, if you can get something more to confirm what you can see in the market, then it's always better. Yeah, you have a higher level of confidence in entering your trade. Bullish divergence, you joining the bottoms here, and what you're looking to see is just an inconsistency in the move, right? So in this case, a bullish divergence, you see price making lower highs, RSI making higher highs. So in this case, the bearish move in the charts or in the market structure is not being confirmed by the momentum or the strength implied by the indicator, right? That's what you're looking to exploit. So just need to keep your eyes on the swing highs or swing lows of your price action, and as well on the indicator. This is very key, and it's important that you just join. If you just get 2 or even 3, then on the third one you should be getting a confirmation to enter a trade. But let's check out on the charts real quick. So here I'm sharing my screen of the charts. Want to look at the likely divergences and convergences. Today I want to take a different approach. I think would look for them in the charts. Yeah. I think together.
Right? I think one of the trickiest things to observe in the markets is actually these divergences and convergences, because they require some sort of practice. Yeah,
you need to have a keen eye onto the detail, and again keep your eyes on the swing highs and swing lows. If they're significant enough, then the better. Yeah,
because now the question becomes, how do you judge what is a swing high, an appropriate swing high, or an appropriate swing low when it comes to identifying these swing points?
So for me, I think I would consider a swing high. Simply talking about a swing high is where the price has made a high level. The price has risen to a high level and fallen. That's a swing high. And if you have 2 points where you have a higher high than the previous one, then you have 2 swing high points, right? So like in this case here, I'm looking at the RSI. I'm showing this divergence on RSI.
This is Euro USD.
Yes. This is Euro USD on 30 minutes. This one can occur on any time frame. Okay. The most important thing that we want to note is that divergence needs to be occurring, or the time needs the time needs to be aligned. I don't know the right term to
between
use,
the peaks.
But the swing highs, right, and the swing highs or lows of the indicator and the price needs to align. They just need to be within the same time, the same space. Let me say that.
In tandem. Yeah.
For lack of a better term. Like if you look here, these two vertical lines I've shown, realize that the swing high on the price, the two swing highs, they're in line with the two swing points on the indicator. Okay, so what I see here is where the price was trending higher, making higher highs, but then I look at the RSI of this oscillator, the second swing high is a little bit lower, and there's some form of a divergence. And later, you realize how the price went down. Okay, so the idea here is, and what we are trying to exploit. You see, this oscillator should be confirming the upward move. Like
the upward movement,
When look previously, I want to change this line into a red one so that we can see. So let me change this into a red line so that we can see. So when we had this uptrend here, this one was being confirmed by the oscillator as well, trending higher and higher. That was very okay. Right?
Yeah, and ideally, in an ideal situation, that should always be the case.
That should be the case. Yeah. But now when it reaches a point where the price now is making higher highs, but when I look at the oscillator, something looks funny. Something's not in agreement. The price is making higher highs, but then the RSI is just falling lower and lower on its peaks. And that's where we are exploiting the weakness. And that one gave into some good movement to the downside. Yeah. If you can check out around.
Out of curiosity, Mathew, we said we wait for confirmations when it comes to these signals. So in this case, the most appropriate confirmation would probably be the price action.
Okay, I think when I talked about confirmation, you would want to add another indicator. Like for instance, if on top of this RSI, I added like a momentum, or maybe add a stochastic, it would confirm, or I would check out for, if I add a stochastic, I would be checking out for overbought area, the price getting from the stochastic getting from the overbought area moving downwards, and realize that here, it's also some sort of a resistance level. So let me try to add, to insert an oscillator, the stochastic oscillator, onto this RSI, and the viewers can as well learn how to add an indicator on top of another indicator. So I'll go to insert indicators, go to the oscillators, and I'm looking for stochastic oscillator. Once I select the stochastic oscillator with the settings that you want to use, here on set the visualization, I want to add onto the other indicator, but this one seems not to show. So if I click OK, I can see it differently. But there is where you'd want to add this oscillator on top or into the RSI, right? In that case, I think I would go to the list of indicators here. Look for the stochastic oscillator. I will drag it and move it straight into the RSI. And then once I click OK, it will be added there automatically, right? Instead of using it independently. So you might want to use it independently, yeah, have the stochastic independently, or add it onto the other chart. It might look a little bit clumsy, but you have to make a choice. So looking at this sum, you know that for confirmation, or for a short position using the stochastic oscillator, you're looking at a key level where the price is getting resistance. In this case, let me highlight those areas. Like here, the price is at a resistance. If you can check that green rectangle I've used up there at the top there.
Yes.
Getting on a resistance. Okay. But then if you look at the oscillator as well, you realize it's on a overbought area and moving to the downside. And the same situation is occurring, is confirming this divergence. So you can use that one as a confirmation as well.
Because the stochastic is confirming that the RSI is in a divergent field. Because if you look at the peaks of the stochastic vis-a-vis the peaks of the RSI, they're downward sloping for the RSI. So that difference between the RSI and the stochastic also confirms that you're indeed in a divergence move.
Yeah, if you wanted to look at that way, well and good, it will confirm as well. But if you want to use the stochastic indicator on its own, then it also confirms the downward move. So you might want to use it as well, either add it on to the other indicators, onto the other indicator, or have it independently to confirm for you that indeed the price is getting from an overbought area, the downside. That's what will confirm for you. The same case, you might want to use another indicator like momentum, but for the momentum, you'll be looking at a different level again. I don't know whether we might be going into that, but it's something you can use to confirm. You can get, the more the confirmation, the better.
Yeah, the higher the probability of your setup.
Yeah, always the better.
Yeah.
All right, so let's check out for another one. For the Aussie yen, Aussie yen, let's check out. So what we are considering here is the peaks.
Yeah, right? How the peaks are behaving on the RSI vis-a-vis the peaks on the chart itself.
Yeah, so I want us to look for them together with the trader, so we see what can we actually find. And in this case, I find another one, right? If I connect this swing high, right? I want to identify that swing high to this swing high, okay? And on the oscillators, on the RSI, I want to check out within that period where we're having those two peaks forming, how are the peaks of the two, how are the peaks of the RSI? And if I try to join them as well, I see that one, there's some form of divergence, okay? Yes. Although it started a little bit earlier with the RSI, the downward move started a little bit earlier. So you see that disagreement there. You have the price trending higher, forming higher highs, but then when you check out on the peaks of the RSI, they're not in line, okay? And within that setup, you can see how the price went lower, okay? That is something as well you can exploit.
Yeah, I think that's a very clear. And in most cases, we have situations where you can't really rely on support and resistance because probably price is making new highs and new lows. So in that case, then you'd probably rely on divergences to ensure that you're spotting potential reverses earlier in the market.
Exactly. Because by the way, if someone wanted, could have used kind of a channel or just considered this one as a support and wait for a breakout.
For extra confirmation.
Yeah. But I see for divergences, actually, they act more as they give a more leading indication as compared to the breaks. Yeah,
because the breaks will have made you enter in a much later stage.
Yeah. With the break, you could have waited for some more confirmation break of that level. But then with the divergences, then it's a little bit more. It doesn't delay as much, right?
Yeah,
it's not as lagging.
It's a leading indicator.
Yeah, it's a leading indication to the movement of the price. I don't know whether we can scan some more, right? Yeah, here we have something. And by the way, I took a trade with this one. Now, look at this. Now, for the two cases that we've looked at, for the two cases that we looked at on this AUD yen and USD card, okay. No, it was AUD yen and Euro USD.
Euro USD, yeah.
These ones are regular divergences. They are leading to a change of a trend. Now, when you look at this for the USD card, right, you realize that the downward trend on these peaks is not being confirmed by the
peaks or the troughs.
By the swing lows of the RSI. And after that, there's a small move that took place. This one happened on 30 minutes, and you can see it give into some good moves up to that level, up until the price has reached some resistance level here. Okay, so
yes,
we can still wait and see. But all in all, we got into some profits here. It's a trade which I took early enough, and here we have maybe some other type of confirmation someone would want to see is on that
the price action itself.
Exactly.
Yes.
Look at this point here. What happened on the what was the price setup around that area? What did you see? It's something that you can as well utilize in terms of getting a confirmation to your trades. At this point here, there was rejection at a key level. Because again, if you can look at this one, it's a key level. Previously a support, right? And then later, it's been previously a support, and the price is getting supported again at the same point. Okay.
Yeah.
Yeah.
Even
so it's a good.
The rejection that you're seeing at that level from the candles themselves, the shapes of the candles, and the sizes of the candles. If you are to look for further confirmation that there is a potential reversal.
Yeah.
Around.
So in this case, I think there are these two candlesticks or these three candlesticks forming here. Initially, these candlesticks form something like a tweezer, but then there is a wick at the top which shows some rejection. Again, the downward move leads to an indecision candlestick, right? So then you see, this is what we would call an aggressive entry right from the beginning. Yeah.
Yeah.
Because if you wait for a confirmation, then maybe you will lose that entry. But if you want to wait for the confirmation, well, no worries. It's a trading strategy as well. Okay.
Yeah. It depends on your. I think we discussed this last time. It really depends on your risk appetite, because you're making more aggressive entries, then in your mind you're already at a higher risk than someone who is waiting for more confirmation.
Yeah. So I have Stanley Lewis asking, how do you set up MACDs and SARs on the screen? So Stanley, if you're here with us already, let me, as we are explaining about these divergences, remember I said from the beginning that you can as well use MACD to check out for these divergences. So let me add the MACD that we have here.
Yes.
And see how you could have used it as well. But you see this, the peaks might be a little bit different. So looking at this one as well, it gives the same setup. If you check out there, look at the peak at the bottom. Yeah. Sorry, no, the lows, the bottom there, the next bottom, it's even more clear
the RSI
divergence. Yeah. So another way that someone can use to confirm the divergence, you can use another indicator to confirm the divergence of the other one, right? Like in this case, it's very clear on the MACD. So how would you add it? Stanley, just search for it on the oscillators, right? And just drag it, drop it there, and you'll have your oscillator. Okay. If you want to add it from the insert button, just go to insert, and if you insert, check out on the indicators, oscillators, look for the MACD. Once you open it up, then of course you have to do the setups and the colors and everything. And then once you click OK, it's going to be added, and you can check out for the divergences. Yeah. Anything to add on that, Sam?
I think when it comes to divergences and which indicators to use. Most indicators that have a separate window and oscillate between two given points can give you clear signs of divergences when you want to use them. So it's up to the trader to have a preference on whatever indicator they want to use. But the most common ones are the MACD, RSI, and stochastics.
Sure, yeah. Remember the key thing that you're going to use, or the key thing that you're looking at in indicators to confirm, or in these oscillators, is to confirm the strength of a trend, the momentum of the trend. And what we are trying to exploit is anything which shows that it's moving away from what you are actually looking for.
Exactly, because it's a divergence. Yeah,
it's a divergence from the norm. So for us to look at those examples, maybe I can insert a few charts here, right? And check out, try to look for them together.
Could you zoom out H4 USD JPY?
USDN on H4?
Yes.
Sure. Here we are.
So right before at the top, right before the top, you can see a clear divergence. Right before that reversal.
This reversal?
From the uptrend, and as it reversed.
This one, right?
Yeah, so the peaks at the top.
I see. You're talking about this, there is this bottom here and this one, right?
Yes, but then when you look at the RSI, it's telling you a different story. The tops, that is, not the bottoms, the tops.
The tops? Okay, all right.
The two previous tops. That one, and then that one.
Exactly, this is quite a clear one. So you have one swing high, another swing high, a higher high, but then look at the bottom, exactly around the same time frame, or the same time frame. So look at that. I'm just moving my cursor so you can see.
Exactly. So in this case, I think when you zoom out USDN, you'd realize that this is the highest it's ever been. So it's quite difficult to depend on support and resistance if there is nothing on the left side of the chart to look or to rely on. So your best estimate, or your best way to spot potential reversals, is through such techniques.
So then what you're implying is most of the times this technique can be very helpful, especially when the price the price action is hitting higher highs or new levels which have not been there previously, and you got no previous levels that you can compare with. Yeah,
exactly. So in this case, then you'd realize that it's better to use techniques other than the typical support resistance techniques.
That's great input, Sam. Great input. And that one is that a very good entry. So it later came to whipsaw to the upside and then went down, but it was a good entry. Someone who entered at that point, if they had some good level of stop loss, then it was not hit and the price went lower. That's okay. Right. So if you looked at this moment, for example, if we try to check out for that movement on lower time frames, because again, now that we're using even if we're using the divergence, that one doesn't prevent you from using the previous tactics of maybe checking from a higher time frame, then going to a lower time frame to look for trades.
Time frame.
Yeah. So let's check if someone got that signal from 4 hours or 4 hour time frame. Let's check out whether that movement was quite a good one on a lower time frame. Yeah. Look at that.
Yeah.
Look at that on a lower time frame. Let's see how many pips someone could have gotten here. This is around 140. Not bad, right?
Yeah, it's a good move.
Not bad. Yeah, it's a good one, especially if you're getting it on currencies. Let's keep on scanning. I want to add pound USD. Let's see whether we can find something on 4 hours. Sam, once you see anything, just let me know. Right.
A question though, what would be the best time frame to start spotting potential divergences and trend reversals?
The best time frame you can find these divergences on any time frame, whether on 4 hours or 1 hour, even on 15 minutes, you can find them. But now, just like we've said previously, if you can find it on a higher time frame, then you're likely to find a bigger move, right?
Yeah.
Likely to find a bigger move, especially when you go to a lower time frame. And you see, one thing you're trying to reduce is you're trying to reduce over trading or being on the charts all the time. So if you can find one good setup from a high time frame, and then you have several hours to ride on the trend or ride on that move. So either on 15 minutes, you find a divergence, and within the next 1 or 2 hours, it's done, and you've got your move complete, and you've taken your profits, and you're done. But if you find it on 4 hours, and you're waiting for like 4 candles or even 5 candles move, probably, if it's a strong one, then it's something you ride for like almost the whole day. Okay.
Yeah. So it's something that can work within your schedule if you're quite held up during the day. Sure. And I see something here. Yeah. I see something here. I've spotted it also. Yeah.
All right. Tell me whether that's the same thing. So we're looking for low for a low point, and then a swing low, and then another lower low. That's one low. Yeah. Right at that rectangle I'm putting it. Let's identify them little by little. Then we have another swing low at that area. Right. Now, looking into the RSI down there, this was the swing low, right? And then next one, the low point wasn't lower than the previous one. So if you use a line to show them, so this is showing a bearish move, but the RSI is not confirming the same. Yes. Right? It's not confirming the same. So in this case, at the beginning, remember I mentioned about hidden and regular. Yeah. This one is an example of a hidden divergence. Okay. A hidden divergence where you have the price changing the trend, but the oscillator is confirming something different, right? It's showing some weakness, right? While the price was more aggressive, right?
Towards the downside, that is, or towards the upside.
Yeah, yeah. However you want to look at it, but this one is the divergence you see here, and the upside won it. Okay. The upside was the winner, moving to the upside, right? So simply look at the inconsistency, right? You might want to read more about regular and regular and the hidden one. Okay. What's more important is to understand the setup more than the terminology or something like that. So this one was again for pound USD 4 hours. There we had, and quite some good move here. Vincent is saying hello. Hey, Vincent. Stephen, you're here. Thanks for coming. Thanks for attending. Any specific time frame? I don't think there's any specific time frame. Can work on any time frame. Brian, and you're loving the webinar. Well, we're happy that you're here with us as well. Thank you so much for taking your time to be with us and attend these sessions. We are always happy to engage with you and keep the discussion really, really lively.
Yes, and I think towards the end of the day, it's the best time to sort of sit back and learn something new or have a recap on 1 or 2 things when it comes to your knowledge with trading.
Yeah, this is the time when you're relaxed. You've done with your day job. It's nothing much stressing you. Okay, quite a good time to learn. So Stephen is saying, what's the best entry level when a divergence occurs? Is it different using another time frame? Well, Stephen, what we mentioned previously is you might want to check out on the divergence. If you find an entry, if you find a signal, there are things you would consider whether you want to enter the trade at that specific time frame or you want to go to a lower time frame, one of the things you want to consider is, do you have an ideal level where you can enter where you can put the stop loss? You realize that if, for example, looking at this trade, let me use a line to check out for a possible confirmation to the entry, maybe at this level. That's where the entry was, because again, you're considering the setup.
So in that case, we had a breakout and a retest of some sort.
So there was some form of candlestick patterns forming here, and this green candlestick, this bullish candlestick here, which has just after this pin bar, right? You can see this candlestick here. That was a confirmation that the price now is moving higher, because if you look previously, these candlesticks don't have any momentum. They don't show any momentum. Upward move, downward move, and then you have this green one confirming a strong upward move. So if you were to enter, because that would be the ideal entry, if someone enters there and you're looking for a good level to put the stop loss, then you'll be thinking about the low. Yeah, that's okay, Sam, right?
Yeah, so
you would consider this as
because you still have to allow the trade some room to maneuver before going in your direction, and there's always that possibility that it might retrace a bit before going in the given direction or the intended direction. So it's good to have a structure or a way of putting your stop loss that factors in all these potential moves in the chart.
Yeah, so that one implies then that you will have to, if you're placing your stop loss at the low of the structure here, right, you'll be going for like 100 pips away. Now imagine how much would 100 pips be if, for example, you didn't have a big account. That would be quite a big loss, right?
Yeah.
So in this light, that's where someone would consider going to a lower time frame, check out whether can you find some more favorable levels that you can check out, or you can put your stop loss. And in this case, looking at this setup on maybe 30 minutes, at 30 minutes, you might have had a better entry for the stop loss, or even going back to 15 minutes. Let's check whether you can get a favorable point. But in this case, it seems it's just the same level, right? There's no any other better point, because if I get from that point there to the down, it's around 80 pips. But again, it's more clear that you can have it at 80 or 90 pips as compared to when you go to 4 hours. What you're finding here, what you're getting here is a little bit on the higher end.
Yeah, I think the higher the time frame, the higher the time frame, the larger your room for error should be.
Yeah, so then
how the allowance.
Yeah, so if you go to a lower time frame, it gets more granular in terms of where you can enter the stop losses. Yeah,
that's why top-down analysis is usually very important if you're planning on having some tight entries in the market.
Exactly. That's exactly. So looking here, it can give you some tighter spots to put your stop loss. Maybe also someone could have considered this. You see, if you go back to this candlestick where there's this big this bearish move, sorry, this rejection here. If you can go back, although that one will be going quite low, but if you can go back, you realize there might be some form of a level that someone could have used. Let's check out this one. I'm talking about this one here, right? So if you had quite a small account and you were looking for some place where you could place the stop losses, then maybe you could consider this below this one here, right? Because again, the drawdown is something you want to be careful of. You're looking at how much you're risking in your account.
Yes. So Steven is asking, how do you know that it has completed the move, or how do you know the divergence has ended and now you have a reversal? I think that's where the confirmation comes in. Don't you think, Matthew?
Yeah, I
Where
think
you
so.
look at other factors, because you can't really observe, you can't really trade divergence in isolation. It can't be a strategy on its own. You need some sort of style that you're already using to confirm whatever it is that you want to spot in the market. So in this case, we are using the consolidation and support and resistance just to find the most optimal entry with a risk allowance.
Sure. I just want to call your attention to this structure we're having here as well. We look at 1 hour just before we got into that trade, or just before you get into that trade, do you realize there's some form of a consolidation happening, right?
Yes.
Yeah, there's already a consolidation happening, and that is
Yeah.
what you want to consider. That's what you would consider in this case to get an entry. Whichever sign the price gets, if the price now breaks to the upside, then you'd want to consider that one as a confirmation, because already you have gotten the divergence and you're looking for the move to the upside.
Exactly. So in this case, the divergence is giving you your bias or what you should be looking for, and then your market structure is giving you the when to enter.
Sure, that's the thing. Okay, and can as well consider the overbought oversold areas of the RSI for exits, but today we're not speaking about the exits. I don't know whether we have time to scan for more, but
I think those are detailed enough, don't you think?
Yeah, it's quite some examples. So just check out and research more about the divergences. Maybe check out on, I don't know whether I can find another one. Euro AUD, put it there.
Just one more.
Yeah, just one more. Pound yen, whether you can find any form of divergence. And here I can see it, right? Although not quite clear. Not quite clear. Not quite clear in this one. On 1 hour, on 4 hours, let's check and see. Right there. Do you see it? So I'm talking about, no, not quite clear. Not quite clear, but still you could have exploited it. And maybe you could confirm this one is another one. So you realize if you're keen enough, you realize that the peak here was at 93. This one is around 87, and right about the same time. Look at that. What do you say about that, Sam? Oh, you've left. So look at this one here. The price is making higher highs, right? This is a higher point. This is a higher high. But then look at the RSI is not trending higher. Yeah, it's a lower high point. So look at the fall that happened. So that's another example you could have used in that case. Yeah. And I think we would leave it at that point.
My connection had dropped off. I think my connection had dropped off a bit.
No worries, I had you covered. I was talking about these. This is what I was identifying here. Yeah, you see, if someone was keen enough, you would see that divergence. Okay, if you can't just use the crosshair, realize that's the previous peak here was around 93. This one is around 86. Yeah, and here we have this movement down. The next peak, the movement down. Okay.
Yeah. So that's very clear.
Sure. So something else that traders can use to confirm this one, or use as a confirmation for the ones who check out on order blocks and previous swing highs. It's order blocks or supply levels when you're looking for a bearish one can be good. For a bullish, then you can check out for demand areas or for the order blocks as well. So Brian is asking for AUD USD 1 hour. Maybe you can look at that one as the last, the AUD USD, Aussie dollar.
On the 1 hour.
On the 1 hour, let me check. Let me look out for Aussie dollar. I might be forced to add it. I don't have it on the selection. So talking about AUD USD. Let me go and search for it. So where do we find it? Aussie dollar. If you find it, call it out. Aussie dollar.
Maybe if you can go to the market watch and then you click on show all.
Okay, then you can look for it.
Yeah, and then you just
let me check whether we can find it manually.
Because these are alphabetical.
Okay.
Yeah.
I show all. Okay, right. Let's show all then.
Yeah, then just press A until you find it.
Okay.
So select on any and then just press A.
It's moving quite fast. It's moving quite fast.
It's too fast.
Yeah, it's too fast for me. Aussie dollar, I find it already. Okay, thanks for that. And on 1 hour, that's what you said.
Yeah.
So that was the request. So let's check out. So wow. Maybe you're talking about this.
I think it's from there. Yeah.
I think this one won't form a divergence, but if you look at the lows, if we look at it this way, then we can find divergence this way. What do you think about that, and some? It's likely to be a bearish one.
Yeah, though not quite clear.
Not quite clear, but it's likely to be a bearish one.
Yeah.
Moving to a higher time frame, it's something quite different. But the thing is, you want to use lows. Now, let me ask you, Sam. Do we use when we're talking about this divergence? If we're looking at the peaks or the swing highs, should it only be on the swing highs of both the price action and the oscillator? What do you think? Or anything that is showing a trend which is not, which is showing something inconsistent with the trend?
Okay,
what do you think? Because for me here, I see this one is showing an uptrend, right? A continuation of that trend. But when I look at the RSI, it's not confirming that strength to the upside. It's falling more and more. Looking at these two peaks.
Yeah. So, is it dependent on whether you're in a downtrend or an uptrend? In that,
you have to look at the trend. Okay.
Yeah.
You need to look at the trend.
I'd assume that's what it's dependent on.
Yeah. So for me, when I'm throwing this question, I just want to challenge the thinking that you should only be joining the peaks, right, of the price action and the peaks of the oscillator. The thing is, you just want to exploit the inconsistency in what the oscillator is showing you and the price action. So in this case, you're having an uptrend, but looking at the oscillator, then it's not the same. Okay. So for me, in this case, it would form a divergence, right? It will form a divergence, and it's likely to be a downward move.
So now we wait for price action to confirm, or market structure to confirm our entry points.
Yeah, because exactly when we have this, if for example we have this break to the downside, then it means that now we will have a confirmation of this downward move, or this decreasing momentum, or the decreasing strength by the RSI, right? Yeah, exactly. So I would want to challenge that one. You can as well go and read more about it, practice, and see whether what I'm saying is in line with what actually the price confirms. I think we have some more questions that you can take. Vincent is asking, how often do we have these meetings? It's your first time and you're really happy. It's helping you, right? We're happy to know that it's really helping you, Vincent. We usually have these sessions Monday, Wednesday, and Thursday, exactly the same time as from 8 to 9. Today we were a little bit late, so we've decided to extend a little bit so that we can cover the questions that you might have, right? So Monday, Wednesday, and Thursday from 8 to 9, we have these sessions. And on a Monday, we will look at, on those days, we will look at the tools or approaches you can do to analyze the market. Like today's market analysis, we look at divergence. On other days, we might decide to have a risk management or trading strategies, depending on what we had covered previously, or depending on the demand.
Yeah, okay. Because as a trader, it's good to have all the tools at your disposal. It's good to be diverse. So in as much as you don't use some techniques, it's good to even observe them in as much as you're using one strategy or another strategy that is different from what you're seeing at the moment.
Yeah. So every Monday, Wednesday, and Thursday. And then on Tuesday, I'm leaving out Tuesday because we have a presentation on the US market open.
Yeah.
The US market open. It's presented by one of our trainers. And you can as well attend us from 5 p.m. Right?
Yeah, very, very exciting market open, because that's when you have the most volatility and a lot of opportunities.
Yeah. So on Thursdays, we have market analyst David Madden doing a recap on what's happening on the markets. Okay. So it's really diversified so that you can get different views on the markets, right? And it's really exciting. Edwin is also giving his input, and Edwin is saying that we should actually be looking at peaks for peaks and troughs for troughs, or lower lows for lower lows on both the oscillator and the oscillator and the price action. It's really something that it's a contentious topic, right? We need to test and see. But for me, what I'm trying to exploit is does the oscillator confirm the trend which I'm seeing? If it's not confirming, there is something to exploit there. But it's always something that we can look out for.
A broader meaning of consistency for you applies to you.
A broader meaning is where if it's an uptrend, then the oscillator should be confirming that. Okay. What I see on the price action and what I see on the indicator should be confirming each other.
Yeah, makes sense.
Yeah, but there can always be a challenge of the status quo. It's a challenge for us to go and research and learn more. Yeah. Okay, all right then. I think up to that level, we can call it a session. You can follow us on social media. Yeah, check out on FX Pesa on the, now because you're on YouTube, this is where we are. You can always check out on these sessions. Also look into the Twitter, right? And by the way, on Fridays, we have Twitter spaces. We have discussions on various topics as well. Look on Instagram, Facebook. We are here to share the insights on the markets and how you can better trade. For me, you can follow me on Twitter and Instagram at Mathew_Kabere. And Sam, yours is?
At Samson Zara. On all socials. And we usually have interesting discussions every other week. So it's good to also follow up on that and see what's happening in the markets.
Okay. All right, then. See you next time. Bye.